All right, I think everybody's in. So thanks very much for joining us today for the Property Market Outlook. If you'd like to listen to this session again afterwards or share it with your teams, we are recording this webinar and it'll be made available on our Customer Marketing Centre. And thank you again for joining us. My name's Cameron Kusher. I'm the Director of Economic Research, and I'm here today to give you a Victorian market update and outlook. And what I'm going to start with is having a look at how the economy is performing. But to start with first, just an acknowledgement of country. I'd like to begin by acknowledging the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay respects to our elders past, present and emerging, and extend that respect to all Aboriginal and Torres Strait Islander people joining us today. So let's start off with how the economy is performing at the moment. And to be perfectly frank with you, the economy at the moment is really weak. Over the last 12 months, the economy has grown by 1%. If we look at the average rate of growth over the last 30 years, it's been 3% growth. Outside of the pandemic, this is the weakest annual growth in the economy since the end of 1991, when we were coming out of that recession. On a per capita basis, GDP's fallen by 1.5% over the past year, and it's fallen for 6 consecutive quarters, something we've never seen happen in the history of the quarterly GDP data. Government spending, as you can see, has been the main driver of economic growth. And really, when you look at what's happening on a per capita basis versus a nominal basis, it's really the strong population growth that is keeping the economy growing at the moment. As a result of the weak economy, households are saving a lot less. So the household saving ratio is the lowest it's been since before the global financial crisis. And this comes after a period when we were saving quite a lot of money due to the pandemic restricting how we could spend. And then you've got household consumption, which typically makes up about 50% of economic growth. It's benign, 0.5% growth over the past year, 3.2% growth is the long-term average. So the economy is certainly not performing particularly strongly at the moment. But we still have this problem of high inflation. Now, later today, we will get a monthly read on inflation, but the quarterly read on inflation is much more holistic, and inflation remains too high. On a headline basis, inflation was 1% over the last quarter, 3.8% higher over the past year. And the underlying measure, which is the much more important one for the Reserve Bank, it was 0.8% over the quarter and 3.9% higher over the last year. Of course, inflation is meant to sit within 2 to 3%. And even though it's come down a long way, we're still a long way above where inflation needs to be. And you might have seen yesterday that the Reserve Bank governor talked about inflation is still too high. And even though they expect that headline inflation will fall back into the target range over the next few quarters, thanks to some of the rebates and subsidies that the government is doing, underlying inflation is expected to be outside of the target range until late 2025. So inflation is clearly continuing to be quite a problem. And inflation's the reason why interest rates have increased so much. So we did get an update yesterday. There was no change. Cash rate's still 4.35%. The market, that chart is a little bit old, but the market is still basically expecting no interest rate cuts until next year. I think we're unlikely to get an interest rate cut this year, and I think we're probably most likely to see rates cut in around February of next year. Keep in mind, interest rates at the moment are the highest they've been in 12 years, and a lot of people were anticipating rate cuts late this year. So they're going to be quite disappointed that they seem very unlikely to come to fruition at this stage. One of the other reasons why rate cuts are some way off is just how tight the labour market is. So at the moment, the unemployment rate is 4.2%, which it was steady over the month, but has increased from a record low of 3.5%. The employment participation rate, which looks at the people of working age and what percentage of them are either employed or actively looking for a job, that's at a record high 67.1%. So you've got more people working, more people looking for work, and you've got a population which is growing really rapidly. just to keep the unemployment rate stable, we need to create about 30,000 new jobs every single month. So that's part of the reason why the unemployment rate has drifted higher. Other measures like the underemployment rate are very low at the moment. Hours worked is still growing. And you can see that over the past year, we've created 2.7, the number of jobs has increased by 2.7%. So we have seen very strong growth in employment over the last 12 months as well. So the labour market is still very strong. We have, though, seen a bit of a decline in the number of job vacancies out there in the market. Housing finance commitments at a national level are still really strong. New lending was up 26.5% over the past year. Refinancing has dropped a long way. That's mainly because interest rates have been on hold since November of last year, and we've seen a lot fewer people coming off fixed rate mortgages. If we look at the components of new lending, which is the chart on the right there, so new lending to investors was up 30% over the past year. Now, it won't surprise you that in Victoria, that's not quite the case, and we'll get to that in a little bit. Lending to first home buyers is up 11% over the past year, and lending to subsequent buyers, people upgrading, downgrading in the market, is up 14% over the past year. It's still really difficult to deliver new housing, and one of the main reasons for this is just how much it costs to build a new home. So you've got two components of this. You've got the inputs, which are the materials, and they've increased by 1.1% over the past year. So the cost of materials is growing at a slow pace now, but those prices are up 34% since the beginning of the pandemic. Then you've got the output cost, which is things like the civil construction and actually building the projects. And that's split into houses and other residential, which is units or medium and higher density. So for houses, construction costs over the past year were up 4.3%. They're up 41.5% since the beginning of the pandemic. And for other residential, it's up 7.7% over the past year. It is only up 25% since the beginning of the pandemic, but it's heading in the wrong direction. You can see that those costs are starting to escalate again. And what this ultimately means is this pushes up the price of new homes. It pushes up the price of doing a major renovation to a property. And it's one of the many factors that's resulting in fewer dwelling approvals. So dwelling approvals did increase in July, but on an annual basis, they were still down 5.9% over the past year. And, a long way from where they need to be. Over the past 12 months, we've built 165 or approved 165,000 new dwellings. The Housing Accord, which runs from July 25 to June 2029 and has a target of 1.2 million homes, that means every year you need to be building 240,000 new homes. So we're a long way from where we need to be. Again, construction costs are part of this. Higher interest rates are part of this. Worker shortages are part of this. There's a lot of reasons why we're not building the housing we need, but it remains really tough to do so. And if you're not getting those approvals, you're not going to get those commencements as well. So we've seen commencements fall a long way. There's still a lot of housing under construction. That's because everything is taking longer to build. But that pipeline of new housing coming in as these homes that are under construction come to their end is really thinning out quite substantially. And then if we look at population growth over the past year, so the population increased by 615,000 people. That's a 2.3% annual increase. There's only 2 quarters since 1980 that have seen stronger annual growth, and that was the previous 2 quarters. It did get up to about 2.5% annual growth. And the main contributor to this population growth is net overseas migration, making up about 85% of that population increase. And of course, people coming to Australia from overseas, a lot of them don't own a home. They need somewhere to rent. And this is putting a lot of pressure on the rental market because there are so many people coming in and so many people looking for a roof over their head. So this chart here looks at the current forecasts on the right of the Reserve Bank, where they think the economy is heading, and I guess just some comments from us as to what we see. So the expectations that economic growth will improve over the second half of this year, and I think that's a reasonable expectation, and that's mainly due to We all got tax cuts July 1, but also interest rates have not changed for a longer period of time. So as interest rates remain steady, the impact of those higher rates fades. And also, yes, inflation's still high, but it is coming down. And that will probably boost economic growth. But economic growth is still going to be well below the long-term average level. At the moment, government spending is the big driver of economic growth. The RBA is forecasting that business investment will pick up and so will household consumption. And that's going to be the main rebounder of the economic growth. Business investment, CapEx spending is already rising and quite strong. But household consumption is the one that's really benign. And I guess a lot of this rebound in economic growth will be reliant on households starting to spend again. We do think inflation is going to moderate further, particularly headline, but even underlying inflation. But we also expect that it's going to remain outside of the RBA's target range this year. And that means that interest rates are likely to remain on hold until next year. As I said, I think February is the time we probably get our first rate cut, and we'll get several rate cuts through next year. I do expect that the labour market is going to weaken, and part of that is the labour shortages will wane. Businesses have been holding on to staff, in some instances more staff than they need, and they'll start shedding that staff. And businesses will slow their hiring as well. The Reserve Bank is forecasting the unemployment rate to peak at 4.4%. Given we're already at 4.2%, I think we'll be very lucky if that's as high as the unemployment rate gets. Wage growth has peaked, and the hope from the federal government and from Treasury and from the Reserve Bank is that we continue to see real wage increases. That is wage growth, which is stronger than inflation. That's happened over the past year for the last 2 quarters. But if we actually look just at the quarterly data, the last 2 quarters, wage growth has been weaker than inflation. So it's not a given. And real wage growth is what really changes things, because yes, the cost of living is going up, but if you actually, if your wage is going up faster than all of the cost of everything else, then you feel like you're getting ahead again. Dwelling investment is expected to persist, the slump in dwelling investment until mid next year. Thereafter, they are expecting or forecasting a rebound, but that rebound is very modest. So the likelihood of us achieving that 1.2 million new homes over the next 5 years is extremely slim. And population growth, we expect to slow from record highs, but it is going to remain at an elevated level. Now, quickly looking at Victoria. So in Victoria, the unemployment rate is a little bit higher than what we're seeing nationally. It's at 4.5%. The long-term average is 5.9%. Very similar trends though. Unemployment has been very low. It is starting to pick up. Job creation is still really strong, a 3.6% increase in the number of jobs created over the past year. You can see that underemployment is below its long-term average at 7%. Victorians are working more hours, although the growth in hours worked has slowed substantially compared to 12 months ago. And the underutilization rate, which is the unemployment rate plus the underemployment rate, is also very low on a historic basis, albeit it is climbing. Looking at the lending environment, remember I said earlier that nationally lending to investors was up 30% over the past year. In somewhere like WA, it's up 75%. In Victoria, it's only up 18.4%. Subsequent buyer lending's a bit stronger, up 17.5%, as is first home buyer lending growth, which was up 20.6% over the past 12 months. So whilst we are getting fewer investors in Victoria, we are getting a bit of a stronger rebound in first home buyer and subsequent buyer lending. Dwelling approvals have come down a long way. You can see, particularly for apartments, back in 2017, 2018, 35,000 apartments were approved a year. Now we're looking at less than 20,000. So that's quite a substantial drop. There's some early signs, particularly around house approvals, that maybe they're starting to turn a corner. But they've got a long way to go to get back up to those recent highs, and a long way to go to get to where we need to deliver the volume of housing we require. And much like what we see nationally, with fewer approvals, there's fewer commencements. There's still a lot of housing under construction, but a lot of that will fade over the next 12 to 18 months. And then if we look at population growth, So at a state level, there's three components: natural increase, births minus deaths, which has been trending low for some time. Net overseas migration has been really strong in Victoria and nationally over the last couple of years. What's changed over the last couple of quarters for the first time in a long time is Victoria is gaining more people from other states and territories than it's losing. Now, you can understand why during the pandemic, a lot of people didn't want to go to Victoria and a lot of Victorians wanted to escape Victoria. But I think this is also now the reason that we're starting to see this pick up is a housing affordability story. Housing in Victoria is starting to look very affordable again because of its underperformance. And that's going to attract more people into Victoria, especially, younger people that have to move to Sydney or Melbourne for a job. They'll be increasingly choosing to move to Melbourne because rents are cheaper, houses are cheaper, and they feel like they might actually be able to buy a house at some point in the future. So from there, let's have a look at what's happening in the housing market. So prices in Melbourne have fallen now for 5 consecutive months. And on a monthly basis in regional Victoria in August, they rose for the first time in 7 months. But if we look at things on a quarterly basis, you can see that both regional Victoria and Melbourne have seen prices falling over the last 3 months. And that's also happening over the past 12 months. So in Melbourne, prices are down 1.7%. In regional Victoria, they're down 1.5%. As you'd imagine, things are varied depending on the regions you're looking at. You can see on the right the different regions of Melbourne in the black and regional Victoria in the red. To give you some context though, so in Perth, prices are up 23% over the past year. In Adelaide, they're up about 15%, Brisbane about 14%, Sydney about 6%. So Melbourne price growth is really lagging behind a long way. If we look over the past year for houses and units, perhaps surprisingly, in both Melbourne and in regional Victoria, units have eked out moderate price increases, whereas house prices have fallen over the last 12 months. And then if we look at where we're seeing the biggest premium for units, for houses as opposed to units, unsurprisingly, the inner city areas have the biggest premium. You can see in each of the inner east and inner south of Melbourne, house prices are more than double unit prices. But elsewhere across Melbourne and across regional Victoria, the price premium for houses is fairly moderate compared to most other states and territories around the country. Now, one of the big reasons why price growth in Melbourne is really lagging is there's a lot more stock on the market in Melbourne and there's a lot more stock coming to the market in Melbourne. And this also holds true in regional Victoria. So this chart here looks at new listings on the left, and on the right, we show the annual change in new listings in black and the change from the average number of new listings in August each year from 2018 to 2022. And you can see that there's a lot more stock coming onto the market. So across all of Melbourne, new listings were 2.7% higher than a year ago, but that was 70.2% higher than that average between 2018 and 2022 in August. Now you can see Melbourne's inner suburbs, 101.2% more new listings than average between 18 and 2022. And that large increase holds true right across Melbourne. If we then look at the total number of properties on the market, so total listings, so that's a combination of new and existing stock, is up 15% from a year ago, and it's 34% higher than that 5-year average. Now, again, comparing this to other states and territories, in Sydney, total listings are up about 8% from a year ago, whereas in Adelaide, Brisbane, and Perth, they're all down and down quite substantially from a year ago, and down more than 40% from that August 18 to August 2022 average. So this really makes Melbourne an outlier. People have got a lot more choice, and there's quite a lot of stock coming to the market every single month. Even though there's more stock coming to the market, those sales volumes are holding up pretty well. So preliminary sales are sales that we get advised by agency groups to us. And you can see that August this year had the most number of sales of any August between 2019 and 2024. And sales volumes are up another 7% from a year ago. The only places in Victoria where sales volumes were lower this year was the Mornington Peninsula, Geelong, Latrobe, Gippsland, Shepparton, and Warrnambool there, and a big increase in sales in Melbourne's inner suburbs. Which then brings us to the level of demand out there. And we measure this by looking at the volume of inquiry per listing. And across both Melbourne and regional Victoria, they are lower over the past year, down 7.5% in Melbourne, down 10.1% in regional Victoria. They've been pretty steady for the last 18 months, though. They do bounce around a little bit month to month, but pretty stable, really, since the start of 2023. I think, people just don't have as much urgency in the Melbourne and Victorian market at the moment because there is a lot more choice. And then if we look at how long properties are sitting on the market, look, properties are still generally selling pretty quickly. The median days on market is 30 days. It was 26 days a year ago. It's bang on the 5-year average in Melbourne. You can see in certain regional markets, there has been a very large increase in days on market. In Shepparton, it's more than doubled. Warrnambool's seen quite a big increase, Latrobe, Gippsland as well. And then in Melbourne in particular, you can see the Mornington Peninsula and Melbourne's western suburbs have seen larger increases in days on market over the last 12 months. So if we have a look at the established market and what the outlook is, firstly, over the last 4 decades, price growth has been really strong. And there's been 4 big drivers of this, and most of them are not going to be as strong going forward. So interest rates have fallen from close to 20% at the start of the 90s to virtually nothing. They've increased a little bit, but as interest rates came down, people could borrow a lot more and that bid up property prices. Credit is a lot harder to get than it used to be. Go and take out a loan. People want to know about private school fees, holidays. Are you planning to have kids? They never used to want to know about that. So that does make access to finance more difficult. I mentioned that employment participation's at a record high level. A lot of that's been driven by more women joining the workforce. And as more women have joined the workforce, household incomes have increased, and that's allowed people to borrow more money. Migration is still very strong, but at the very least, 3 of those 4 drivers are unlikely to be as strong going forward. Now, this doesn't mean prices won't grow, but it does mean prices are not going to typically rise as fast as they have in the past. And I started in property 25 years ago, and it was always property prices double every 7 years. Then it became 7 to 10 years. Now it's more like 10 to 15 years. And I think we'll continue to see that pushing out. In saying all of that, though, the level of demand for housing is holding up pretty well, given how quickly interest rates rose, where they are, and the fact that there's a lot more stock on the market and coming to the market, particularly here in Victoria at the moment. But the lift in the volume of stock for sale has resulted in some moderate price declines. And quite simply, buyers have got a lot more choice. Buyers just don't have that fear of missing out that they have in markets like WA at the moment. If someone doesn't secure the property that they want at the moment, I think, they're less willing to overpay because the sense is, well, something else will come onto the market soon, and that something else could be better and it could be cheaper. So for vendors, they need to be really realistic on price because buyers can be a lot more selective in this type of market. I think the high cost of new housing is likely to see people continue to preference existing homes over new homes, and less inclined to do major renovations and more inclined to move, given the uncertainty and costs around that. We need more infill housing, but there's a lot of political and financial hurdles to that. But I think it's in dire need, particularly in those desirable inner city suburbs where people just can't afford those prices anymore. And I think the increasing cost of renting is likely to see more people that have the capacity to do it to become first home buyers. And this is probably going to be more prevalent in Victoria because you've got fewer investors in the market. So first home buyers don't face the same level of competition from investors as they do face in other states and territories. Now, turning to the rental market. So over the past 3 months, overall in Melbourne, rents were unchanged. But you can see in different parts of the city, this has played out quite differently. Interestingly, the inner suburbs have seen rents fall. And then some of the outer areas have actually seen stronger rental growth. If we look over the past 12 months, rents in Melbourne are up 9.5%. That is quite a slowdown from about 16% year-on-year increase 12 months ago. Melbourne has the cheapest rents of any of the major 5 capital cities, so $575 a week. Now, if you're in Sydney, $720 a week. If you're in Perth, $650 a week. Brisbane, $630 a week. Even Adelaide is $580 a week. So while you're living in it, of course, rents are going up a lot in Melbourne at the moment, but relative to other cities, rents are reasonably affordable. It's also very interesting to have a look at where rental growth has been the strongest. Not intuitively where you would think, the outer east and southeast. And I think this speaks to the fact that people are being pushed into areas further away from the city and further away from where they'd ideally like to live because the cost of renting in those markets has become so high. If we look at the split between house and unit rents, you can see fairly similar growth between the both. House rents have been stronger the growth has been stronger in Melbourne, whereas unit rents in regional Victoria have seen stronger growth over the last 12 months. If it weren't for these additional taxes on investors, you would probably see a lot more investment happening in Victoria right now. Have a look at unit rental yields in Melbourne, 5.1% gross rental yield. You'd probably have to go back about 20 years to see the gross rental yield on a unit as high as it is currently in Melbourne. But of course, investors aren't coming into Melbourne because they face higher taxes and taxes that they don't face anywhere else in the country. So investors are acting with their feet and they're going and investing in places like WA, Southeast Queensland instead. The number of new rental listings is still very low on a historic basis, but you can see it's actually 2.7% higher than it was a year ago, and it's marginally higher than that 5-year average. So we're starting to see some more stock coming onto the market. And even on the total rental listings, yes, they're definitely very low on a longer term average basis, down 18.5%, but there is 8% more properties available for rent this year than there was last year. And this is not just something we're seeing in Melbourne, we're seeing this in most of the major capital cities at the moment as well. So maybe some early signs that the rental pressures are easing. We know overseas student arrivals are slowing into the country. We also know that household sizes are getting larger as people go back into share housing in order to afford to pay the rent. So obviously this is bad news for landlords, but for people renting, it does look like supply is starting to free up a little bit. You can also see this when we look at rental inquiries per listing, which in Melbourne have dropped quite substantially over the past 12 months, 19.7% lower, whereas in regional Victoria, they are higher. Again, though, have a look in Melbourne, Southeast and Outer East are the areas where we're seeing the highest level of inquiry. And the lowest level of inquiry is in Melbourne's western suburbs and in the inner suburbs. West, more supply in that market, but the inner suburbs, I think that speaks to the cost of renting there, forcing people further away. We're also seeing vacancy rates drift a little bit higher. So the vacancy rate in Melbourne now is 1.7%. And you can see that the inner suburbs have got the highest vacancy rate in Melbourne, along with the western suburbs, whereas the tightest or the lowest vacancy rates are in those outer east and the southeast suburbs of the city. And we're also starting to see properties sit on the market a little bit longer. So the median days on market for a rental property was 20 days a year ago. It's 22 days this year. That's still well down on the 5-year average of 27 days. But again, creeping higher, reflective of more choice for renters out there, which is, I guess, long overdue and appreciated by renters, but not so much by landlords who have obviously seen the cost of servicing their mortgage debt on their investment property increase quite substantially. So what's our outlook? You know, there's several factors that have driven the increase in rents. You've had a reduction in household size through the pandemic. You've had very low levels of new housing construction. And this is an important one to understand, because if you look at what is largely being built, and I'm talking mainly about apartments here, most of the new apartment stock is targeted at the owner-occupier segment. What that means is, yes, people come out of their big family homes, but they're probably sold to other owner-occupiers. But it also means when you're building something new, you're getting fewer units overall because you're doing larger units, But you're also not growing that rental pool because investors aren't buying into these new homes and they're not then becoming available for rent. So that does definitely impact on things. Labor costs and shortages and financing costs are also contributing to less new housing construction. At the same time, we've had rapid population growth and most of that coming from migration, most of those migrants needing somewhere to live. We have seen rents continue to rise over the past year, but that rate of rental growth is slowing. We are starting to see that tight supply ease a little bit, but we're not getting as many new investors in the Victorian market as we are in other states. And we know that a lot of investors are selling out of their Victorian properties because of these higher taxes. The big challenge, though, for renters is the capacity to afford their rent. And how do people respond to this? They move to less ideal locations where rent's cheaper. They move from larger properties into smaller properties, and that can be a house to a smaller house, or that can be a house to a unit, or they shift back into share housing. And we've seen a lot of this trend on our flatmates.com.au site. Probably not something that a lot of people are willingly doing, but out of necessity because of the cost of renting, but also the cost of everything else has gone up so much. People simply can't afford to rent by themselves anymore. How do we address this, the shortage of rental stock? On the supply side, what you can do is you can build more housing. And even if we fixed everything that was wrong and stopping housing being built right now, it would still take many years for that to show up. Or you get more people investing in residential property, which even in Victoria is starting to happen a little bit, but government policies are making it hard for investors to really buy into the narrative of buying an investment property in Victoria at the moment. And then on the demand side, what can you do? You can lower the rates of migration. And we know the federal government's trying to implement caps on overseas students. You can increase Commonwealth rental assistance. So we've done that each of the last 2 financial years, but that was after 20 years of essentially not adjusting it at all. And of course, lower income households are the ones most at risk of falling into homelessness. The other thing you can do is assist or encourage more people to become first home buyers. And there's a lot of schemes out there that are doing that. But with the cost of living rising so rapidly, it's very hard for someone that's renting to save a big enough deposit to make that leap out of renting and into their own home. And of course, higher interest rates mean that generally it's going to cost a lot more to service a mortgage than it is to pay rent. But I do think that the expectation of further increases in rents, albeit at a slower pace, we'll see more investors come into the market. And I do think it will encourage those renters that have the capacity to do so to exit the market and purchase, especially as interest rates are expected to come down over the next 12 to 18 months. Servicing that higher mortgage debt will become easier. And that brings us to the end of my part of the section. But we do have several questions here that I'm going to try and answer for you as we go through. So I'm just having a look here at some of the questions that are coming. Don't have any. So if you do have any questions, please pop them in the Q&A or the chat, and I'll do my best to answer them. I'll give you a minute or two to, here we go. How will the new rate of absentee tax impact the Victorian house and land property market from a foreign buyer point of view? Yeah, the absentee tax is obviously just another hit for people that want to invest in the Victorian market, and it is going to hit both house and land and apartments. We know that a lot of foreign buyers, particularly Indian foreign buyers that live in multi-generational housing, do have a preference for house and land. And realistically, a lot of these things are just cash grabs for the government that's in a lot of debt at the moment. And unfortunately for Victorians, it's the Victorian economy that suffers from this. I've got a question here from Mike. What is driving the higher volume of listings in Melbourne compared to other states? Yeah, Mike, it's a really good question. It's one we've kind of tried to delve into. I guess a lot of people have a lot of different opinions about what's driving it. I think for some people, people that have held their properties for a long time in Melbourne, they have seen a lot of equity gains, and maybe it's the fact that price growth is really sluggish now, that they're looking to use those gains to upgrade in the market. We do know that a lot of people that own investment properties are selling out of the market at the moment as well. I think also a lot of people during the pandemic were unable to transact for a long period of time there. So maybe it's a case that people have outgrown their homes. They're not wanting to do a renovation or can't afford a renovation to their property, so are instead moving on to their next property. I think one of the other things that's starting to drive more properties onto the market as well is a sense that you can actually now start finding somewhere to rent, because we do know that a lot of people, after they sell their property, need to transition through the rental market for a period of time. And if they're actually able to find somewhere to rent to do that, they might be more inclined to sell their property. Another question, when do you expect the pendulum to swing back to investor demand? Will it take a reversal of negative government policies, the reversal of interest rates, or positive price growth to stimulate demand? Yeah, this is a really good question. Look, my personal view overall on Melbourne, and I live in Queensland, so I'm in no way a Melburnian at all, but I think Melbourne property looks really cheap. And I do think that Melbourne is due for an upswing. I think what we need for an upswing in the Melbourne housing market is a moderation of that stock on the market, and we need interest rates to start coming down. So if we can get that decline in stock, I think in the next sort of 18 to 24 months, we will start to see prices swing back. In terms of investor demand, it's really going to be down to the numbers stacking up, because I don't think the government is going to take away these additional taxes on investors. And even if the state government changes at the next election, the level of debt that needs to be repaid some way. So I'm not even sure that the opposition could take away those policies. So I think it's just more that from an affordability standpoint and from an upside standpoint, it's going to really need just to really stack up much better than those other states and territories do. Another question here. Can you clarify reduced household size through the pandemic regarding the rental market? So what happened during the pandemic is the average household size shrunk quite a lot. Now, quite a lot, it went from 2.5 people to 2.35 people, which doesn't sound like a lot. But when you calculate that across the whole of the country, that creates a lot of additional demand for housing. And why did it shrink? Because a lot of share houses split up, because it was very hard when everyone was working from home to work from home. But also no one wanted inner city apartments. So a lot of people jumped out of share houses and went and got a 1-bedroom apartment for a similar price. Unfortunately, a lot of marriages broke up during the pandemic as well. So that shrunk the household size as well. So that creates, once more people started coming into the country and the population started growing again, that really drove a big increase in the demand for housing, and our supply was not able to respond as quickly enough. Another question, would the increased working from home impact the inner city rental accommodation in Melbourne? Look, I think to some degree, but honestly, I think most of the people wanting to rent in the inner city area of Melbourne are young professionals that are going into the office pretty regularly, or it's overseas students that are studying at Melbourne's universities. So I don't think so. I think the demand there is still pretty strong. It's just now that it's at a price point that a lot of people simply can't afford. Another question here. Apologies. Could you give some guidance about the sales market in the outer metro inner regional areas such as the Macedon Ranges? So the slides will be possible to get on the Agent Marketing Centre after this, and you can go through those slides, and there is information there on those local markets. Okay, so I think that might be the end of the questions, and we're getting pretty close to time. I might give it one more minute if there are any further questions. In the meantime, we are going to, there is one just popped up. What will happen if negative gearing is removed? Won't this disincentivize investment and thereby reduce rental properties on the market and contribute to increases in rents? I think that would happen. There is talk today in the paper that the opposition is looking at changes to negative gearing. I think they're going to find it very hard to remove it completely. I think what they will look to do is maybe limit the number of properties that you can negatively gear, or look at grandfathering in negative gearing only being available on brand new properties. it would be very hard for them to cut and dry, say we're going to get rid of negative gearing, because you know that a lot of people would exit the market, and that probably would see prices fall quite significantly. Last question, and then we're going to wrap it up. I think that was the last question, sorry, and we'll wrap it up from there. Just before you leave, we are going to pop up a poll on your screen, and we'd love to hear your feedback on how you found today's session. There's the poll. As I said at the start, if you want to listen to this session again or share it with your teams, please do so. We definitely encourage that. The webinar will be available on the Customer Marketing Center. And again, thanks for your time. Thanks for joining us. We are going to be doing these regularly, so we hope you come back. We hope you tell everyone else about it and they come to the next session. And otherwise, hopefully I'll see you sometime soon.